Hey guys, it's Akeem here. So you may have seen yesterday that Alibaba jumped by over 8%, which is a pretty large increase for a company that has been downtrending pretty much for the last year and is actually down over 48% in that period, right? So I thought that today we'd discuss what was the cause of the increase, right? What news was released which resulted in the increase, and then we'll also discuss whether there's potential for a reversal of this increase, right? So is the increase that we are seeing transitory, or are we now going to see Alibaba pick up some momentum? And then we're going to go over a recap of my fundamental analysis of the business after taking into consideration all of the changes surrounding the business which have happened since my previous videos on Alibaba, such as them being so kind as to donate 100 billion RMB to the Chinese Communist Party in a pledge to common prosperity. And if my sarcasm regarding that is not coming across over video, then yes, I am being sarcastic, and yes, I do think it's ridiculous. But anyway, we'll get into that, we'll discuss all of that, and we'll talk about whether that changes the fundamentals of the business and whether this is a company that we can still make money from regardless of all of the nonsense that appears to be going on at the moment. So let's get into it. So in terms of what caused the 8% increase in Alibaba, as well as the increases in other Chinese tech stocks as well, we can see this article reads here: shares of Alibaba gained strong upside momentum amid optimism on US-China relations. Recent reports indicated that President Joe Biden and President Xi Jinping will have a virtual summit in 2021. This summit will be a great opportunity to ease tensions between the world's two biggest economies, and Chinese stocks are reacting accordingly. So of course, a good relationship between China and the US is going to have a positive impact on Chinese stocks, right? So it will help to alleviate some of the concerns that a lot of investors have when investing in Chinese stocks, right? So one of those being the potential for Chinese stocks being delisted, and then the other one being the variable interest entity structure in which we have to invest in Chinese stocks. And I've made a video on this, so you can go and look at that if you want to. But in effect, that has a lot of people concerned, because if there's not a good relationship between China and the US, and because these variable interest entity structures are actually illegal in China, it's just a sort of loophole. There's the concern that President Xi Jinping will just decide to completely cut these variable interest entity structures, effectively rendering any investment in Chinese stocks completely worthless, right? But that's for another video, but effectively that's why a good relationship between China and the US is always going to be positive for Chinese stocks. The article then reads that Alibaba stock has been declining through 2021 as Chinese authorities put pressure on various industries, from tutoring to online gaming, in order to solve current social problems. Fears about potential default of China's developer Evergrande and small developers have also hurt Chinese stocks, including Alibaba. Previous problems of Alibaba's founder Jack Ma also served as a material bearish catalyst for the stock. In other words, it feels like for the last year or so, every other week there's been some negative news and negative sentiment around Chinese stocks, which has been pushing them all further down, right? Which doesn't feel great for anybody that is holding these stocks. However, you have to remember that short-term noise generally doesn't have a long-term impact, right? So long-term fundamentals will always reign supreme, and that's what I'm hoping for Alibaba's stock. But anyway, we'll come into fundamentals later on. Let's move on with the rest of the article. So what's next for Alibaba stock? Currently, analysts expect that Alibaba will report earnings of $9.30 per share this year and $10.82 per share next year. So the stock is trading at roughly forward 14 PE ratio, which is cheap for the current market environment. So in one of my videos on, I think it was defensive stocks, it might have been Lockheed Martin, it might have been British American Tobacco, either way, whichever one it was, I mentioned that the forward PE ratio of the S&P 500 at the moment is around 21 or 22. So a forward PE ratio of 14 for a company like Alibaba, which is very fast growing, is very, very cheap. But that's not to say that there's not reasons for it being so cheap. We've seen all of the news, right? So it's not a surprise that actually this has a suppressed valuation at the moment. However, that hasn't stopped legendary investor and Warren Buffett's right-hand man, Charlie Munger, doubling down on his position in Alibaba for his personal portfolio in the Daily Journal Corporation. So we can see here that he added 83% to his current position, and the reported price of that was around $148, right? So effectively, he's doubled his position in Alibaba, and it now represents 20% of his personal portfolio. Now, of course, you should never just copy somebody's portfolio, right? But this should give investors a degree of confidence if somebody like Charlie Munger, despite all of the short-term noise that's coming out around the stock, is continuing to buy, right? And actually, it's a sizable position within his portfolio at 20%. That should give you an element of confidence, or a degree of confidence, and it might not be a bad idea, right, after you've done your own due diligence and if you think it's right for you. And that investment by Charlie Munger was despite the news that came out that said Alibaba had pledged to invest billions by 2025 for common prosperity. And the reason I put invest in quotations is because anybody in their right mind understands that actually they haven't agreed to invest, right? It's not an investment for Alibaba. Effectively, the Chinese Communist Party have said, look, you're making a lot of money and you need to be distributing that wealth to benefit everyone, right? And so effectively they're making donations and they're being forced, as far as I'm concerned, to make donations. And if they're not literally being forced, effectively it's something that they feel that they need to do in order to appease the Chinese Communist Party. Now, this was a piece of news that was particularly concerning for me, right? And it still continues to be a concern. And the reason for that is because if Alibaba can be forced to effectively donate their cash, donate their profits, and those are the profits which are supposed to be due to the Alibaba shareholders, then of course that's a problem, because when are we ever going to see a return on our investment? In other words, when are those funds that we've managed to raise going to be returned to shareholders? Now, it is a little bit complicated, right? Because of the variable interest entity structure, effectively Alibaba shareholders of the ADRs have a right to the profits, but not the assets of the company, right? So it's a little bit of a grey area effectively. But regardless of that, it's still news that I don't like to hear. And I certainly don't want Alibaba to be forced to effectively donate their cash elsewhere when they could be using that to invest in the business in order to grow further. Anyway, the article here reads that China's Alibaba Group will invest 100 billion yen by 2025 in support of common prosperity. It said, becoming the latest corporate giant to pledge support for the initiative driven by President Xi Jinping. So what was the first thing that I did? I took the emotion out of it. I went across to my valuation model and I effectively input these donations into my model to see how that affected the long-term value or the true fair value of the business. Now, the difficult part here, right, is that it's easy enough to put in the 100 billion yen as donations into my model, and that's fine. But the one thing that we don't know is what about by 2025, the Chinese Communist Party then decide that actually Alibaba need to donate a further 200 billion yen. And then by 2030, they need to donate another 300 billion yen. And this could just go on and on and on and on, right? And Alibaba really have no say in the matter. So that is a massive concern. And it certainly makes you think that you need a greater margin of safety just in case that might happen, right? So there's definitely a lot of risk to this investment. There's no doubt about it. However, when we look at the fundamentals, it might be worth the risk. So we're going to quickly run through my updated valuation model for the business, taking into account the various changes that have happened, such as the common prosperity pledge that Alibaba have committed to try and see how the fair value of the business has changed, right? So we've got a current market capitalization of $428 billion. So these are in dollars in here, and then the rest, all of these results are in Chinese RMB. Right, so we've got revenue in year one of 912 billion RMB, right? And you can see that's taken from the analyst estimates here. For year two, we've got 1.1 trillion RMB, and again, that's an analyst estimate, right? So that represents a 27% revenue growth for year one and a 20% revenue growth for year two. For years 3 through to 5, I've gone with a 15% revenue growth, and then for years 6 to 10, I've gone with just 10% revenue growth, which in my opinion is pretty conservative for a business that's grown at 58%, 51%, 35%, and 41% over the last 4 or 5 years, right? So clearly going from sort of 27%, bringing that down through to 15%, and then dropping that even further, right, to 10% revenue growth per year, I would argue is pretty prudent. We've got a gross margin of 41%. Now, in my previous videos, I explained why these gross margins were decreasing. Effectively, it was due to their acquisitions of lower margin businesses. Fine, right? That's how they're growing their business. However, I think that the gross margins are actually going to increase as time goes on. And that's because as the Alibaba cloud business, which typically operates at 60, 70, sometimes even 80% margins, starts to become a larger part of the business. So I wouldn't be surprised if we saw that gross margin actually increased back up to around 45 and even 50% later on, right? But to be prudent, I've kept that at 41%. For operating expenses as a percentage of revenue, I've left that at the average of the last 5 years. And you can see how consistent that has been, right? So 32, 29, 30, 26, 29, and we're using an average of 29%, so that's fine. Weighted average cost of capital of 9.2%. If you want to, you can pause it and have a look at the inputs there. And then cash and cash equivalents, so they've got $71 billion of on their balance sheet in cash, and then they've only got $22 billion of debt. So they've got a fantastic balance sheet. Then you will see here, I've added the CCP Common Prosperity Pledge. I just think this is nonsense. But anyway, right, so we've got 10 billion, 15 billion, 20 billion, 25 billion, and 30 billion. So the logic behind this is that I think that they will ramp up their donations in order to meet the 100 billion by 2025, And you can see that the total of those is 100 billion, right? That's 100 billion RMB, which is around $15 billion. So that is included in the income statement, right? And it's also included within our discounted cash flow. So you can see here that we've calculated the free cash flow after those CCP donations, right? So I'm taking it into account that they are going to be donating 100 billion RMB to the CCP over the next 5 years, and that is included within our cash flows, right? So bear in mind that 100 billion RMB is included in the valuation. Now, in terms of how I've arrived at the unlevered free cash flow, right? So the first thing that we do is take the EBITDA for each of the years, and then we then apply the changes based on their capital expenditures, changes in net working capital and tax, and then we arrive at the unlevered free cash flow. We then calculate what the unlevered free cash flow is as a percentage of EBITDA to allow us to project going forward. Now, in terms of their EBITDA margins, right, we can see that EBITDA as a percentage of revenue was 47%, and that has fallen all the way to 27%. And actually, when we look at analyst estimates, they're estimating that in 2022, it'll be around 21%, and in 2023, it'll be around 22%, right? So I've said that I've applied an EBITDA margin of 22% going forward, which is 5% less than their most recent year, right? So I think that's pretty prudent. And then we're using an unlevered free cash flow as a percentage of EBITDA of the average of the last 4 years. And the reason I haven't included the 5th year is because 91% appears to be sort of an anomalous result here, and therefore I'd rather remain prudent, right? So we could either use 80%, which is the average of the 5 years, or we can use 77%, which is the average of the 4 years. So the value of any business or any investment is the present value of all future cash flows, right? So effectively what we're doing here is we're trying to calculate what will be all of the future cash flows to this business for as long as it lives, right? And then effectively we're discounting those back to today's value. And when we do that, we get an intrinsic value per share of $272. So as far as the discounted cash flow is concerned, Alibaba is vastly undervalued, right? So $272 is the fair value today for this price according to the discounted cash flow, compared with the current share price of $158. However, when we come to the earnings multiple model, we get a slightly different story, right? So earnings in 10 years, according to the model, according to the inputs that we've just run through, is expected to be $65 billion, right? We apply a PE ratio of that of 15, which is pretty low if you ask me, right? So if we look at their previous sort of PE ratios, the previous multiples that they've been able to command, we can see that the average over the last 3 years has been 31. We've seen highs of 50, right? And lows of 17, which is pretty much where we are now. So despite all of the news that is currently out about Alibaba and the Chinese relations, it's still only ever hit a PE ratio of just under 17, right? So I think that 15 is relatively prudent, and so I'd be comfortable applying that going forward. Right, that gets us to an intrinsic value per share of just $156, which still isn't bad. It would mean that according to the multiple of earnings, it is fairly valued at today's price. If you ask me, I think that this is probably too conservative, right? I think that gross margins are going to improve, which will, vastly improve the valuation that we get here. And actually, just to show you the impact of that, if I go across and if we increase the gross margins to, let's say what it was in 2020, or 45%, if we then flick across to the fair value, we get an intrinsic value per share of $186, according to the earnings multiple model. So, it's quite a significant swing considering that it's just a small movement in the gross margins. And when we consider the point that I was saying, that as their Alibaba cloud business grows, which is higher margins, I think that 45% margins in the future is probably realistic, if not conservative. But just for the sake of prudence, I've gone with just 41%. Anyway, we take an average of the two because we don't want to sort of weight one of our assumptions for more than the other. We get a fair value per share of $214, which would be a margin of safety of 35%. Okay, so that's what the company is potentially worth today, right? But what will the company be valued at? What will it be worth in, say, 2025, right? So we take the 2025 revenue, we apply the EBITDA margin of 22%, which was referring to earlier on, right? We get an EBITDA in 2025 of $55 billion. I apply an enterprise value to EBITDA multiple to that of just 14. Now, if we look at historically, what are investors, or what have investors been willing to pay? We've seen an average over the last 3 years of around 30, highs of 40, and lows of just under 15. So again, I think that by 2025, when all of the short-term sort of noise goes away, if it does, right, an enterprise value to EBITDA multiple of 14 is pretty prudent, right? It's lower than it is today, and given all of the sort of the negative sentiment around the stock, I think that it's fair to say that it's going to be at least 14, in my opinion, right? That gets us to a enterprise value in 2025 of effectively $772 billion, which is a 2025 price target of $313, which would mean that you'll be growing your money at 18% year over year. You compare that with the historical average of the S&P 500 of somewhere between 9 and 10% on a compounded basis. If you're growing your money at 18%, then you're doing very well. However, I say all of that to say this, right? So we can make a number of assumptions and we can try and forecast what the results of the business are going to be. And we might be able to do that fairly accurately. But one thing that is so difficult to get your head around is the real risk of the CCP and what that's going to mean for the stock going forward. Ultimately, the business can perform as well as it wants to, but if the CCP just continues to force them to make donations, then as far as I'm concerned, the stock is not worth anywhere close to what the forecasts or what our valuation models suggest that it is. So it's really difficult, right? It's a stock that comes with a lot of risk. If you like risk, then it might be one that's, worth looking into. But if you don't like the geopolitical risk that comes with the stock, then to be honest, I would probably just avoid Chinese tech stocks altogether, right? Or Chinese stocks in total, right? This is a company that I'm invested in, so clearly I'm comfortable with the risk, but it's so difficult, right, to put a number on that amount of risk, right? What's the cost of the risk? I don't know. We'll see if I'm right in the long term, but ultimately, right, time will tell. But if we flick across to the charts, right, and we can see here that we're currently at $156, and actually in the pre-market, we're at $159. And what I've done is I've added some lines to the chart, right? So I've added a top and bottom, and we can see that that's effectively downtrending all of the way. And then the yellow line is the 50-day moving average, and the blue line is the 200-day moving average. Now, for me personally, before we start to see some really significant momentum with this stock, it needs to push back or push past the 50-day moving average, which is at $168. We're currently going to be, hopefully at open, at around $159. So we're not too far away. Now, of course, it's always difficult to try and predict, and it's almost impossible really, right, to try and predict any short-term movements in a stock. However, there are certain indicators that you can look at that generally do give you a little bit of a positive indication, right? So pushing past the 50-day moving average might be one of those. I don't think that the 200-day moving average is a realistic expectation in the short term, right, in the next 6 months, even in the next year. To be honest, I can't really see that happening. But certainly if we push past the 50-day moving average, I wouldn't be surprised to see this stock back up $190 or somewhere in that region. However, with all that being said, I could be completely wrong. As the market opens, this stock could fall back down to $140. That's the joy of the stock market, right? But anyway, I hope you guys have enjoyed the video, and until next time, thank you.